Starbucks is up more than 33,000% since it came public in the 1990s. That turned a $10,000 investment at its IPO into more than $3.3 million today. But Starbucks stock is currently down more than 30% from its recent high. So is this growth story busted? Here's everything you need to know about investing in Starbucks today. My name is Brian Feroldi.
And my name is Brian Stoffel.
Thanks to StockCard.io for sponsoring today's video. As of the time of this recording, I own Starbucks. Brian Stoffel does not.
Brian, Starbucks is a $100 billion company that trades under the ticker SBUX.
Starbucks' mission statement is to inspire and nurture the human spirit, one person, one cup, and one neighborhood at the time. I like that they have a mission statement. This isn't really my favorite.
I agree with you, Brian. It's not my favorite either. But when it comes to what Starbucks does, they sell coffee and coffee-related products at cafes throughout the world, and increasingly, mobile and to-go ordering has become very important.
Starbucks has split its revenue by about 50-50. About half of its stores are company-owned, half are franchised out, and also about 50% of them are in the United States, 50% of them are international.
It's also worth noting that Starbucks does earn money from its consumer packaged goods that are available in places like convenience stores and gas stations.
Now, one thing to applaud about investing in Starbucks today is it has very low customer acquisition cost. The brand name Starbucks has become ubiquitous with selling coffee, and the company has millions of raving fans around the world.
When it comes to customer demand, we gave the company a medium rating. Now, look, there's no doubt that people need their coffee and they need it every day, but they might not be willing to pay up for Starbucks. It is a luxury good, and we did see in 2008 when the recession hit that revenue declined.
On the plus side, coffee is a consumable good. If you buy Starbucks once, you're going to buy it again. That means that the vast majority of this company's revenue is recurring. Turning to Moat, we did not give the company any credit at all for the network effect. However, it is worth noting that Starbucks has lots of great locations that are located conveniently, so you could make an argument that that adds to the company's competitive position.
When it comes to switching costs, we gave Starbucks a low rating. Now, obviously, this is a habit-forming trip that you make to get your coffee, but also the company's rewards program is so generous that could entice customers to stick with Starbucks over the long run.
There's also an argument to be made that Starbucks has developed such immense buying power that it has a low-cost production model when compared to smaller rivals.
But by far, the most important moat that Starbucks, the company, has is its brand name. It is top of mind when people think of caffeinated beverages, and that is incredibly important.
Now, the last few years have been very challenging operating environment for companies like Starbucks. However, over the last couple of years, Starbucks has continued to open up new locations, find new ways to deliver coffee to people, and add new customers. We think that the company's moat is expanding or is at least stable.
Now, when we turn to the company's financials, it's a little bit odd. We know that 2020 was vastly affected by the pandemic, and because Starbucks has a different fiscal calendar, the trailing 12 months only include one extra quarter of growth. That said, it is consistently bringing in lots of cash, currently at $30 billion in revenue.
Now, Starbucks' gross margin is actually pretty low at 28.6%. That's actually a negative in my opinion.
As you can see, however, net income has been consistently positive. While it took a huge dip during the pandemic, it has recovered to pre-pandemic-like numbers of over $4 billion.
Investors should applaud that free cash flow largely tracks net income too. So this company produces gobs of cash flow each year.
And that free cash flow is important because when you look at the balance sheet, this isn't our favorite. There's a lot more debt than there is cash on hand, but knowing that you're going to bring in $4 billion in free cash flow every year makes that acceptable.
Finally, Starbucks has been producing positive net income for decades, and its returns on capital are very strong.
Now, when we look at Starbucks management, we have an interesting situation. Howard Schultz essentially founded the company, having bought out the small chain decades ago and made Starbucks what it is today. He stepped away from CEO duties for a second time a few years ago and handed the reins over to Kevin Johnson. But within the past month, Johnson has announced that he was retiring. On an interim basis, Schultz has come back as the company's CEO.
Now, when it comes to Glassdoor ratings, Starbucks has historically been a very beloved employer and gets great reviews. More recently, the numbers have been heading in the wrong direction, and only 71% of employees recommend the company to a friend.
And when we look at insider ownership, it's less than 1%, which isn't terribly surprising given how old and how big this company is.
When it comes to potential, we think that Starbucks has a low level of optionality. Yes, they're coming out with new ways to bring coffee to people in more convenient locations, and their consumer packaged good focus is definitely interesting. However, the company has tried and failed numerous times with its food offering, so we think the company is going to be selling coffee for the foreseeable future.
Turning to operating leverage, we see the company that is already being optimized to produce tons of cash, so there's not much room for this to grow moving forward.
When it comes to the addressable market opportunity, the global coffee market is estimated to be about $110 billion, and Starbucks has captured a huge chunk of that. However, I think that Starbucks can actually create demand by opening up new stores. For example, there's a Starbucks near me. I would not be a Starbucks customer if the company's location wasn't so close to me. I think that same attribute can be said for the company's stores around the world, so that it creates demand by opening up new stores. So I think the company's TAM is actually understated.
And when we look at revenue growth, we can take solace in the fact that almost all of it comes from organic revenue.
How is Starbucks done delivering for Wall Street? The answer there is pretty good. As mentioned previously, this stock is up more than 33,000% since its IPO. It has been one of the best performing stocks over the last 30 years.
However, over the last 5 years, it's run into some problems. And while a 73% return isn't bad, that is lagging the market.
Now, Starbucks does have a history of beating Wall Street's estimates, having done so in 3 of the last 4 quarters.
And we found out just this morning as we were filming that the company had decided to pause its buyback program to reinvest in its stores and its people. It is not paying down its debt, but it does offer a dividend.
When it comes to competition, at scale, there's companies like Dunkin' Donuts and Caribou Coffee, as well as there's plenty of smaller rivals in individual towns. However, we don't think that they pose a serious threat to Starbucks' business.
The next risk to be aware of is geopolitical, and that's because Starbucks is making a huge bet on China. If anything happens with their operations there, it would be a huge hit to investors.
Another risk to bear in mind is that there is an outside force to be aware of, and that is coffee prices. When coffee prices rise, so do Starbucks' input costs.
And when we look at valuation, we think that this is a medium level. The company trades for about 23 times trailing earnings and free cash flow. That's not super expensive, but not a screaming deal either.
So, what should investors watch moving forward? First and foremost, keep an eye on comparable store sales. This is sales at each existing Starbucks. We want to see this number remain positive and continue to grow for decades to come.
Second, keep an eye on margins. By doing so, you can track to make sure that the cost for the input of coffee is not becoming too high, and you can see if the company's decision to transition to smaller store formats to facilitate drive-throughs might drive more profitability.
Third, keep an eye on international growth. International is the reason to buy this company, and it's going to be the thing that drives its long-term growth. We want to see signs that those international stores are winning over consumers and the company's top line continues to grow. So how did Starbucks score in our investing checklist? The answer there might surprise you. On mine, it got a 74, which is in my investable category, hence why I own shares myself.
On the other hand, at my framework, it ended up in the fragile category because I'm not convinced that the moat is super wide, nor am I convinced that there's a lot of optionality left. Now, that doesn't mean that I don't like Starbucks, the franchise. I actually think it's a great company, but as an investment, it's not getting my dollars.
All right, we made our calls. It's a thumbs up for me and a thumbs down for Brian. So I'm going to head on over to stockcard.io to hold ourselves accountable. So Starbucks is going to go in Brian Stoffel's fragile portfolio. This is his thumb down portfolio. So I'm going to place a new order. The ticker symbol is SBUX. We're going to do a buy decision. Today's date is April 4th. This is an $86 stock. So I'm going to buy about 13 shares. And this scored a 4.5 on his investing checklist. Next, I'm going to go to my thumbs up portfolio, and I'm going to do the exact same thing.
And while Brian is doing that, we want to remind folks that you can see these portfolios at stockcard.io for free. We also encourage you to enter the Beat the Bryans contest. It is a contest taking place throughout the whole year. The first quarter just ended, and hundreds of participants who outperformed Brian and I already are getting 3 months of VIP access to stockcard.io. Enter now, pick 5 stocks that you think will do the best between now and 2022, and if you come in first place, you can win a $1,000 prize.
There you have it. Starbucks gets the thumbs up from me and the thumbs down from Brian. Who's right? We'll just have to wait to find out. Brian's out.